Hello again, it's Lynette Khalfani-Cox. I'm the co-founder of AskTheMoneyCoach.com, the site that answers all your money questions, no matter what they are. So today I want to ask and answer a question that someone wrote me about, and I want to share the answer with you guys. It's kind of a real estate question, so take a listen. This gentleman wrote me and said, assume a person is self-employed as a professional and making a sufficient income to rationally afford, not irrationally, he said, rationally afford a car, a mortgage, etc. Okay, so far so good. Then he wrote, is the tax advantage of leveraging money, i.e. accumulating debt, purchasing a building in a relatively stable economy, local economy, he said, to work out of, great enough to overcome the opportunity cost of the money in other wealth vehicles? Okay, let me break down this question for you in case you didn't get what he's trying to ask here, and I think I understand what he's saying. He's saying, I have enough money to do, the stuff that I need to do. I have a car, a house, and I'm stable on that front. But I'm thinking about buying some property to work out of, and is the tax advantage that I'll get for doing that worth it versus everything else I could be doing with my money? In other words, if I didn't put my money into real estate, maybe I could invest it or do something else with it. So what do you think? Well, here's my answer to this gentleman and to anybody else out there who's thinking about buying property in any shape or fashion. Doesn't matter whether this is a first home you're thinking about getting, say your primary residence, a second home, a vacation home, a timeshare property, some commercial real estate. I think it's a big mistake if you're thinking about buying property just for the tax advantage. Don't let the tax dog wag what is the expression there? Don't let the tax tail, so to speak, wag the financial dog. I don't know if I screwed that up totally, but you get what I'm saying. The idea is that taxes are a secondary consideration. In some cases, they should even be tertiary, the third thing on the list that you think about. Because you have to look at whether or not the investment itself makes sense. Now we're getting a little bit more on point to the question, which is, if I tie my money up in real estate, is that a good thing right now in a relatively stable, he said, local economy? He didn't tell me exactly where he lives or was thinking about purchasing real estate, which section of the country, but presumably pretty stable. And we know that property prices have been, in general, a little bit on the rebound. He's saying, is this worth it, or should I do something else with my money? The opportunity cost question that he raises is a good one. And really, I think that it could be worth it from an investment standpoint if you have a whole bunch of other things taken care of. So before I see people investing in any way, investing in real estate, investing in the stock market, etc., I like to see them cover what I call the financial basics. So pay off all your debts. If you have high rate credit card debt, and I don't mean you have to be mortgage free, like pay off your mortgage or whatever. But if you have, 14 or 15% credit cards, then yeah, pay that first before you think about investing in property or investing in the market, stock market or something like that, because you're going to get a better effective return on your money by knocking out the high interest rate debt first. Make sure you have life insurance. Make sure you have disability protection. Make sure you have a will, especially if you're a married person or if you have minor children. And make sure you have an adequate cash cushion. Now, he talked about being able to afford some things from a spending standpoint, perhaps even from a cash flow standpoint, when he said, I can reasonably afford a mortgage, a car, etc. Whatever else he's doing, he's spending money on. He feels like it's okay. I've got the cash flow to cover it. That's fine. But what about some of these other financial basics I just mentioned, like the cash cushion? I think everybody needs to have a very sizable cash cushion, ideally 6 months plus worth of expenses. So for this gentleman, let's say your bills all in are, let's say $4,000 a month. I just made up a number. I want to see you have $24,000 set aside. 6 times 4,000 is $24,000. So you want to do those things first before you think about jumping into real estate or commercial property ventures, things of that nature. If you've covered the basics, then it might be time to think about other things that you can invest in and get a nice return on your money. But make sure that you're buying the property for the right reason. You said to work out of, and is the tax advantage of that. Now, do you mean I'm going to get a tax write-off for my business, or were you trying to negotiate or trying to establish some other personal tax benefit as a result of buying property? That's a question you should obviously look in more detail or ask in more detail with your own accountant or CPA, because I don't know all of your particulars, and I don't know what else you have going on in terms of where else are you getting write-offs and how might you be positioned to get to maximize your tax strategies. Frankly, some people, you might be thinking about buying a commercial real estate property, and their accountant might say, wait, you haven't even maxed out your retirement savings account. You can get a lot of benefit from that too. So it's really hard for me to say whether it's worth it from that standpoint. But one thing I can answer unequivocally is to say, no, I wouldn't buy a property just for the tax advantage, especially if the investment, the underlying investment itself, I didn't think was a good investment to begin with. So this has been Lynette Khalfani-Cox of AskTheMoneyCoach.com.